from my side. So today we will revise the chapters Income Tax Authority, Assessment and Assessment Procedure, and Appeal and Revisions. Okay, so let's start. So let's start with income tax authorities. Okay, so at the top of income tax authorities are CBDT. Below CBDT, there are two different wings. One is investigation wing and one is assessment wing. So the designation of officer under both the wings are different. In case of assessment wing, we call it commissioner. In case of investigation wing, we call it directors. So in case of investigation wing, they are Principal Director General of Income Tax or Director General of Income Tax. Then there is Principal Director of Income Tax. Then below it, Director of Income Tax. Then additional DIT, joint DIT. And then Deputy Director of Income Tax. Then Assistant Director of Income Tax. This is a starting point of IRS. Then below it, ITO. All these are part of investigation wing. Similarly, there are similar office ranks are there for assessment wing. At the top, it's Principal Chief Commissioner of Income Tax, then Chief Commissioner of Income Tax, then Principal Commissioner or Commissioner, and equivalent to the Commissioner there is CIT Appeal, Commissioner of Income Tax Appeal, the Appellate Authority. Then additional CIT or additional CIT Appeal, then Joint CIT or CIT Appeal, then Deputy Chief Commissioner of Income Tax, Deputy Commissioner of Income Tax, Assistant Commissioner of Income Tax, ACIT, and below it, ITO. So these are called assessment wing. TROs and inspector are also part of income tax authorities. So wherever in the chapter in the Act Income Tax Authority what is written, it refers to all these officers. Okay. Section 117 and 118 govern the appointment and control of income tax authorities. So central government appoint an income tax authority, but income tax authority below the rank of assistant commissioner or deputy commissioner may be appointed by CBDT or any other person authorized by the central government. Okay. CBDT may authorize any income tax authority to appoint any executive ministerial staff so as to assist them in their execution of the work. Or direct any income tax authority shall be subject to such other income tax authorities. Okay. Now, section 119. 119 is the section in which the CBDT issues orders, circulars, instructions. Okay. Such order instruction plus section 119 empower CBDT to issue any order, instruction, or direction to other income tax authorities. So such orders are issued to the income tax authorities, as we discussed above. Such orders are binding on such authorities. So CBDT being at the top of the income tax authorities, so any order issued by CBDT is binding on all income tax authorities. However, CBDT cannot issue any such order which require income tax authority to make a particular assessment, in a particular manner, or any order which interfere in the discretion of appellate, CIT appeal or JCIT appeal in exercising appellate function. Okay. The board. So what type of order generally are issued by the board? The board issue order, general special order, which are not prejudicial to the assessee in respect of any class or classes of cases, income or cases, setting forth guideline, principle or procedure to be followed by other income tax authority in the work related to assessment, collection of revenue, initiation of penalty proceedings. Okay. So CBDT can issue any type of circular or order except the two which we discussed about, that is, the order should not interfere with the appellate functions of CIT appeal or JCIT appeal and should not direct the income tax authority to make assessment in a particular manner. The order can be issued to avoid any genuine hardship in a case or class of case. Okay. But such an order cannot direct the CIT appeal or JCIT appeal to admit an application or claim. Okay. After the expiry of the period specified under that. The order can remove any genuine hardship or relax any requirement contained in the provision of chapter 4, the heads of income, or chapter 6A, deduction, where the assessee has failed to comply with such requirement specified in such provision, subject to the condition that the CBDT feels that the default in complying was due to a reason beyond the control of the assessee, and assessee has complied with such a requirement before the completion of assessment. Okay. AO, assessing officer being income tax authority, is bound by every circular issued by CBDT, even if the circular deviated from the law. CIT appeal is not bound by the circular which affects its affiliate discretion, but is bound by administrative circular. The administrative circular may be that first disposed of the cases where the tax demand is less than 1 lakh or more than 1 crore, as the case may be. These circular orders or instructions are not binding on ITAT, High Court, or Supreme Court because they are not income tax authorities. If a circular deviates from the law and it is beneficial to the assessee, then AO is bound to follow such circular. So AO is bound to follow all types of circular, whether it's beneficial or not, whether it deviates from the law or not. However, if the circular deviates from the law is against the assessee, then also AO is bound to follow it. But then assessee has two options. Either the assessee can challenge the circular itself in a writ petition before High Court and High Court will quash it, or the assessee can challenge the assessment order passed in accordance with such circular before the CIT appeal. And CIT appeal is not bound by the circular while discharging its appellate function. Taxpayer charter. The board shall declare a taxpayer charter and issue such order, direction, instruction, or guideline to other income tax authority as it may deem fit for administration of such charter. Okay. So jurisdiction of AO. Who AO has a jurisdiction of an assessee? So where AO is vested with jurisdiction over any area, she shall have. So the assessing officers are given jurisdiction on different area. So if any AO has a jurisdiction on any area, then he shall have jurisdiction on the person carrying on having a principal place of business or profession situated in that area, or if such person is residing in that area. AO shall also have jurisdiction all income accruing, receiving, or receiving in such area assigned to him. Question to determine who has a jurisdiction to assess a person. So there's a challenge whether AO has a jurisdiction to assess a person or not. Then, as to a jurisdiction of AO, it shall be determined by the Director General or Chief Commissioner or Commissioner. As to the jurisdiction related to area within the jurisdiction of Director General, Chief Commissioner or Commissioner, such decision shall be taken by them because they are senior officer concerned DGIT, CCIT or CIT. And if they do not agree, by the board or any such DGIT, CCIT or CIT as may be notified by the court. Of course, a higher income tax authority may exercise the power and perform the function of the lower income tax authority and trustee to the lower income tax authorities. Power to transfer cases, section 127. So transfer case from one AO to another AO. If both AO are subordinate to the same DGIT, CCIT or CIT, then the order of transfer case shall pass by the DGIT, CCIT or CIT. In any other case, if DGIT, CCIT or CIT of both AOs agree, then the DGIT, CCIT or CIT as the case may be, from whose jurisdiction the case is being transferred shall pass the order. If the DGIT, etc. are not agreeable, then the order shall pass by CBDT or any such DGIT, CCIT or CIT as notified by the board. However, before passing any such order of transfer of case, and the authority shall record the reason in writing for doing so, and assessor shall be given an opportunity of being heard. However, opportunity is not required if all the offices, if all such officers are situated in the same city. The transfer is not necessary that the case can be transferred only after the conclusion of the proceeding. The transfer of case may be made at any stage of the proceeding and shall not require reissue of any notice already issued by the predecessor AO. Section 129. Where during the course of proceeding, an income tax authority is succeeded by another income tax authority, the successor may continue the proceeding from the stage at which the proceeding were left by the predecessor. In such case, assessee may demand that before proceeding is so continued, the previous proceeding or any part thereof may be reopened or the assessee may be reheard. Now, most of the income tax proceedings are held as faceless. So the income tax authority have a faceless jurisdiction. This faceless scheme are made so to eliminate the interface, to impart greater efficiency, transparency, accountability by eliminating the interface between income tax authority and the assessee to the extent technologically feasible, and optimizing utilization of resources through economies of scale, and introducing a team-based assessment, exercise of power. Now the main section comes. Section 131, power of income tax officers. An income tax authority not below the rank of assistant or DRP, dispute resolution panel, or any authority not below the rank of assistant as notified by the CBDT. In respect of section 1991, fair has the same power as are vested in the court under the Code of Civil Procedure, CPC. And what are these powers? They have the power of discovery and inspection. They can enforce the attendance of any person, including any banking official, and examine such person on oath. They may compel the production of books of account or other documents, and they may issue commission. This power under section 131 can be exercised even if no proceedings are pending with respect to such person. 131.3, power to impound this. An income tax authority not below the rank of assistant, so any authority of the rank of assistant or above, or DRP or any authority notified by the CBDT for the purpose of section 90 or 98, may impound and retain in his custody any books of account or other documents. However, such retention, before making such retention, the authority shall record his reason and obtain the approval of the seniors, Chief Commissioner, Deputy Director General, Commissioner or Director, for retaining such books of account in his custody for a period exceeding 15 days, excluding holidays. Power to call for information, section 133. So in this section, the income tax authority has a power to call for information from any person. So the assessing officer, joint commissioner, or JCIT appeal or CIT appeal may sought the following information from the following person. From the firm, they can ask for the name and address of their partner and the profit sharing ratio. From the HUF, they can ask for the name and address of the manager and members of the HUF. From a trustee, guardian, or agent, they can ask for the name and address of the person for whom he is trustee, guardian, or the agent. Any assessee, from all person, they can ask him the name and address of all person to whom the assessee has paid any amount more than 1,000 together with particular such payment. Any stock or commodity broker, dealer, agent, name and address of all persons to whom either the exchange has paid or received any sum together with particular such payments. An income tax authority not with the rank of assistant. So any authority of assistant or more above may require any person, including bank company, to furnish any information which may be useful for any inquiry or proceeding under that. So information can be sought even for the purpose of inquiry. However, in case no proceeding is pending, the above can be exercised by the Director General, Director, Joint Director, Deputy Director, or ADIT, the Investigation Wing Officers, Chief Commissioner or Commissioner, and officer below the rank of Commissioner with the prior approval of Commissioner, or any authority notified by the CBDT not below the rank of Assistant. Power to collect information, section 133B. An income tax authority may enter. So now in under section 133B, the authority may enter the place of business of the assessee to collect some information. The income tax authority may enter any building or place within the area assigned to it, or any building or place occupied by any person in respect of whom he exercises jurisdiction, at which business or profession is carried on, whether such place be the principal place of business or not, and collect information therefrom. So under section 133B, the income tax authority can enter only the place where the business profession is carried on. The timing of the entry, the authority can enter during the hours at which such place is open for the conduct of business or profession. Okay. But under section 133B, the income authority cannot impound any book or other document or any other valuable article. And for the 133B, even an inspector can enter and seek the call for the information, collect the information. Power to call for information, section 133C. In under section 133B, the income tax authority had a power to enter the place of business. Under 133C, they are asking for the information. The income tax authority may, for the purpose of verification information in its possession. So there is some information in the possession of income tax authority. Now they want to get it verified. They may issue a notice to such person requiring him to furnish any information and document which may be useful to any inquiry or proceeding under this act. So they have some information. They may ask any person to give the verification to verify such information. On the basis of such, they can use such information, such verification in any inquiry or proceeding. Survey. So there are two important powers which the income tax authority have. One is search and there is survey. What's the difference? In survey, I do not seize any valuable article. Okay. Which I can do in case of search. So survey happens under section 133A. On a survey, an income tax authority may enter any place in the area assigned to it or any place occupied by a person in in respect of whom he exercises the jurisdiction, or any place in respect of which he is authorized for the purpose of this section by such income tax authority who is assigned the area within such place situated or who exercises the jurisdiction in respect of the person who occupies such place, at which business or profession or charitable activity is carried on, whether such place is a place or not. So for survey, you can enter even the place where charitable activity is being carried on. Okay. No action under this section can be taken by an officer below the rank of joint officer without the approval of Director General or Chief Commissioner. Upon entry, the officer can, what is the power under survey? The officer can inspect the books of account. They can place mark of identification on books of account or other document. They can make copies therefrom. They can impound books of account for maximum of 15 working days. They can check or verify the cash, stock, or other valuable article. They can make an inventory of any such cash, stock, or other valuable article, and record statement of any person. So, in respect of valuable article, they can only check and make the inventory. They cannot seize them, but they can impound the books. Books of account or other document can be retained for more than 15 working days after the approval of Chief Commissioner, Director General, or Commissioner of Director. If it is found that books of account are kept at some other place, then the authority can enter such other place also. At what time you can enter for a survey? If the place is a business profession, you can enter only during business hours. In case of any other place, you can enter after sunrise but before sunset. So there is a timing only for entry. There is no time limit for exit. If an income tax authority is of the opinion that it is necessary to do survey at any function, ceremony, of event, then it can do the survey, but only after the conclusion of such ceremony, function, or event. This was a normal survey. Now there is also a TDS or TCS survey to determine whether the assessee is complying with the TDS and TCS provisions. So an income tax authority can conduct survey for the purpose of verifying as to whether TDS and TCS has been directly collected and paid as per the provisions of the Act. The authority can enter the premises after sunrise but before sunset. The authority can inspect books of account and record the statement. But here, in case of TDS survey, it cannot impound the books of account or make an inventory of cash, stock, or other valuable article. And TDS surveys cannot be made on charitable institution. If any person is required to afford a facility to the income tax authority under this section either refuses or evades to do so. The income tax authority shall have all the power under section 131 against such person. So it was survey in the section 133 where the income tax authority can enter any place of business or charitable activity and impound the books or make a inventory of cash, stock, other valuable article. But in case of search, there is a maximum power which the income tax department has. So who can authorize search? Issue search warrant. So of course, the chief commissioner, director general, commissioner or director, or any additional commissioner or joint commissioner, joint director, if empowered by the CBDT, may authorize any AO. Okay, the AO is authorized called authorized officer. On whom can the search be authorized? So, search can be authorized if the income tax authority has a reason to believe that any person to whom notice in section 142(1) or someone under section 131 is issued or might be issued to produce books of account or document, and if fail to produce or will not produce such books of account or document. Okay. If any person is in possession of any money, bullion, jewelry, or the valuable article, and these assets represent wholly or partly the income which he has either not or will not be disclosed for the purpose of that. Okay. What are the power in this case of the authorized officer? They can enter and search any building, place, vessel, vehicle, or aircraft where he has reason to suspect that the books, money, etc. may be kept. He has power to break open the lock of any door, box, locker if keys are not available. He can place marks of identification on books of account, documents, and make copies therefrom. He can make inventory of any cash, stock, other valuable article or thing. He can search any person who has got out of, who is about to get into the building, vessel, place, vehicle, etc. If authorized officer has reason to suspect that such person has secreted about his person any such books of account or cash, bullion, jewelry, etc. He may require any person who is in control of books of account or document maintained in electronic form to afford necessary facility to inspect them. He can, this is the important, he can seize any books of account, document, or money, bullion, jewelry, etc. found under search. However, stock cannot be seized. Or he can examine any person on oath, and such statement may be used as an evidence in any procedure under the Act. Now, there's a concept of deemed or constructive seizure. What is this? If due to the nature, volume, or weight of any article or good, such good cannot be seized, then the authorized officer can pass an order of deemed seizure. It says, where it is not possible or practical to take physical possession of any asset due to weight, volume, or nature, then authorized officer may serve an order on the owner or the person who is in possession of such article that he shall not remove, deal with, or part with such asset without the prior permission of authorized officer. The above shall not, of course, shall not apply in case of stock in trade. So, asset in respect of which any such order is part shall be treated as same as such asset has actually been seized. There is another thing called prohibitory order or order of restraint, where it is not practical to take physical possession of any books of account or the asset for the reason other than the reason discussed above. Then authorized officer may serve an order on the owner or the person who is in the immediate possession that he shall not remove, deal with, part with such asset without the approval of authorized officer. This order is valid for a maximum of 60 days. Prohibitory order is not considered a seizure of the asset. Okay. Now, assuming there is any building within the area of jurisdiction of a chief commissioner or commissioner, but such officer has no jurisdiction over the person referred above, then it shall be competent for him to exercise the power under this section if he has reason to believe that any delay in getting the approval from the person who has jurisdiction over such person is prejudicial, would be prejudicial to the interest of revenue. Where such has been authorized by a chief commissioner or commissioner and some other chief commissioner or commissioner not having jurisdiction on the assessee have reason to suspect that any books of account are kept in any building not mentioned in the search warrant, he may authorize the authorized officer to search such building also. While doing such, the authorized officer can seek the service of police officer or any other officer of the government. Presumption, assumption under such. Where any books of account, other document, money, bullion, jewelry found in possession of any person, it may be presumed that such books of account, document, money, bullion, or the valuable article belonging to such person. Okay, so there's a presumption. If anything is found with you, then it belongs to you. The content of such books or other document are correct. The signature or every other part of such book or other document is which is purported to be in the handwriting of one person is in the handwriting of such person only. The document which purport to be attested or stamped by a particular person is actually being attested or stamped by such person. So these are reputable presumption which the act makes, but these are reputable, meaning if the assessee can prove that these are wrong, then it can prove. It may be noted that the above are rebutable presumption. On facts and with evidence, the assessee may rebut the above presumption and prove that the facts are otherwise. The person from whose custody the books and other documents are seized are allowed to make copies thereof and take extract therefrom. Where the authorized officer has no jurisdiction over the person searched by him, the books of account, money, bullion, jewelry, etc. shall be handed over by the authorized officer to the AO having jurisdiction over such other person within a period of 60 days from the date on which search was completed. During the course of within 60 days from the date of conclusion of the search, the authorized officer may, for reason to be recorded in writing, and being satisfied that it is necessary to do so for protecting the interest of revenue, and with the previous approval of Director General or Director, provisionally attach any property belonging to the assessee. As always, the provisional attachment is valid for 6 months, after which it is automatically vacated. Also, within the 60 days of the conclusion of the search, the authorized officer may make a reference to a valuation officer, referred to in section 142A, who shall estimate the fair market value of the property and submit a report within 60 days from the date of receipt of such reference. The reason to believe, reason to suspect as the case may be is not required to be disclosed to any person, any authority or appellate tribunal. Even these reasons are not required to be disclosed to the appellate tribunal. The provision of Code of Criminal Procedure latent search shall apply to search under this section. Now, what is this requisition? Requisition is calling for books, account, or documents from any other department. So it says where the officer has reason to believe to authorize search on any person, and a search has already been conducted by any authority under any other law on such person, and the officer may authorize any AO, we call it requisitioning officer, to require such authority to deliver books of account or assets seized by them as early as possible. Where books of account have been delivered to the requisition officer, the provision of section 132, 132B shall apply as if such books of account had been seized by this officer. Now, this is important. Application of books of account and assets seized. Books of account. It shall be released within a period of 1 month from the end of the quarter in which the order of assessment is made. For any books of account and beyond this period, the permission of Director General, Director of Chief Commissioner or Commissioner is required. However, the Director General, these officers shall not authorize the retention of books for a period exceeding 30 days after completion of all proceedings, including the penalty proceeding, in respect of the year for which such documents are relevant, are completed. The SSC may object the approval granted by this senior officer by making application to the board, and board may, after giving the SSC opportunity of being heard, pass such order as it thinks fit. Now, how this money, bullion, jewelry which has been seized shall be used. So, falling amount can be recovered from the seized asset. Any existing liability, including liability under the Black Money Act, but advance tax not form part of existing liability. And the amount of liability determined on completion of block assessment and the assessment for the year in which search is initiated or acquisition is made, including the penalty and the interest amount. But assessee can make an application within 30 days from the end of the month in which asset was seized and explain the nature and source of the acquiring of such asset to the satisfaction of the assessing officer. Then such asset can be released to the assessee with the prior approval of Chief Commissioner or Commissioner after adjusting the existing liability of the assessee. Such release shall be made within 120 days from the date of conclusion of such. Order of application of seized asset, how the seized asset shall be applied. So if there is any cash or money seized, that money shall first be used for discharging the above liability. After that, if the money falls short, then asset may be sold for discharging the liability. If any asset remains, then they shall be handed over to the assessor. The government shall pay a simple interest of 0.5% per month or part of the month on the funding amount, which is amount seized plus amount received on sale of the asset minus money released minus aggregate amount required to meet the liability. So whatever excess amount left, it shall be, the government shall pay interest on such excess amount. Such interest shall run from the date immediately following the expiry of 120 days from the date when search was completed to the date of completion of assessment. So this was all about income tax authorities. Now we'll move to next chapter, the return of income and assessment procedure. This is important because generally a question of 4 to 6 marks, 4 to 5 marks is being asked from this chapter. So as you all know, section 139(1) requires, give the condition required for the filing of return of income. So it says that following persons are mandatory required to furnish return of income. Who are such persons? So one is company, every company, firm, including LLP, university, college, or other institution referred to in section 35, business trust, or investment fund. So these entities are mandatory required to furnish return of income in all cases, whether they have income, whether they have loss, whether they have no transaction. Whatever the case, they are mandatory required to furnish the return of income every year, in all cases. Okay. Any other person shall be required to furnish return of income if his total income or total income of any other person in respect of which he is assessable exceeds the basic assumption limit. Okay. So other person are required only if their total income exceeds the basic assumption limit, which is 4 lakh under the new regime and 2.5 lakh under the old regime. However, while comparing the above total income, which we have to compare it with the basic assumption limit, you shall not give the credit, give effect to the provision of Chapter 6A, the deductions, or exemption under Section 54, capital gain exemptions, 54B, D, etc. Okay. So firstly, these entities, company, firm, etc., are mandatory required to furnish return of income. Then any other person is required if his total income without giving effect to the provision of Chapter 6A or capital gain exemption exceed the basic assumption limit. If any resident and foreign resident is not required to furnish return of income as above, then he is required to furnish return of income if during the previous year he holds a beneficial as a beneficial owner or otherwise any asset, including financial interest in any entity located outside India, or if he's a beneficiary of any such asset located outside India. So if he has any asset if he has any foreign asset, whether he's a beneficial owner or registered owner, then he's mandatorily required to furnish return of income in all cases if he's ROR. Or if he's not a beneficial owner or registered owner, but he's a beneficiary of any asset, any foreign asset, then also is required to furnish return of income. Or he doesn't have any asset outside India, he's not even a beneficiary. But if he's a signing authority in any bank located outside India, signing authority of any foreign bank account, then also he's required to furnish return of income mandatory if he's ROR. However, if he's a beneficiary, then he's not required to furnish return of income if the income of such asset is includable in the income of person referred to in clause A, mean beneficial owner. If the beneficial owner of such person is filing return of income, then the beneficiary of such asset is not required to furnish return of income. Who's the beneficial owner? Beneficial owner means a person, means an individual who has provided directly or indirectly consideration for the asset for the immediate or future benefit, direct or indirect, of himself or any other person. So beneficial owner is a person who has actually paid the consideration for the asset. And beneficiary, who is the beneficiary? Sorry. So beneficiary means an individual who derives benefit from the asset during the previous year, and the consideration of such asset has been provided by any other person. So if he is only deriving the benefit, but the consideration is not given by him. A person other than company or firm who is not required to furnish return of income as above shall furnish the return if during the previous year he has deposited an aggregate amount exceeding 1 crore in current accounts maintained with the banking company or cooperative bank, or he has incurred an aggregate expenditure exceeding 2 lakh for himself or any other person for travel to a foreign country. He has incurred an aggregate expenditure exceeding 1 lakh towards electricity consumption. So if he has deposited 1 crore or more in a current account, or has incurred 2 lakh or more for foreign travel, or 1 lakh or more for electricity consumption, then also he is mandatory required to furnish return of income. Or if his gross received in the business exceeds 60 lakh, or in the profession exceeds 10 lakh, or if the aggregate of TDS and TCS in his case is 25,000 or more, but the limit shall be 50,000 if he's a senior citizen, or he has deposited an aggregate amount exceeding 50 lakh or more in the saving account. So if any of these conditions are satisfied, then also the person is required to furnish return of income. So we have seen there big requirement of furnishing return of income. See, for a firm or company, return is required to be furnished in all cases, irrespective of the income. In any other case, any other person, they are required if total income without giving effect to the provision of Chapter 6A or Section 54 exemptions exceed basic exemption limit, or aggregate amount depositing current account is more than 1 crore, or saving account 50 lakh, or they have incurred expenditure of more than 2 lakh for foreign travel, 1 lakh for electricity consumption. If the gross received in the business it is more than 60 lakh, or the gross received in the profession is more than 10 lakh, or if the aggregate of TDS and TCS is more than 25,000 or 50,000 in case of senior citizen, then in such case, also the person is required to furnish return of income. If you are not following this, but if you are ROR, then you are required to furnish return of income if you are the actual owner of any asset outside India, or beneficial owner, or beneficiary, or signatory of a foreign bank account. Clear? So all these persons are required to furnish return of income. What is the duty of furnish return of income? If in case of company or any person whose accounts are required to be audited under this act or under any other law, or if the assessee is a partner of a firm whose accounts are required to be audited, or spouse of such partner, if the provision section 5A applies to such spouse. Then all these cases, the return is to be furnished by 31st October of the assessment year. However, is transfer pricing applicable? Then the return is required to be furnished by 30th November. Meaning, if an assessee is required to furnish a report on section 92E, or any partner of a firm who is required. If a firm is required to furnish a report, then firm comes under first bullet and its partner comes under second bullet. And also the spouse of such partner, if it's section 5 is applicable on such spouse, then 30th November. In all other cases, it's 31st July. Okay. So for 31st October, who all are required? A company, a person whose accounts are required to be audited, all partner of the firm whose accounts are required to be audited, spouses of all such partner if they are covered by section 5A. 30th November, any person who is required to furnish a report in section 92E, all partners of a firm who is required to furnish a report in section 92E, spouses of such partner if section 5A is applicable. In all other cases, 31st July. Now, what are different types of return? So for this, section 139(1) says who all are mandatory required to furnish return of income. Then 139(3) says loss return. It says if the following losses shall not be carried forward if the loss return is not furnished within the due date specified in section 139(1). Which all losses cannot be carried forward? Loss under PGBT, capital gain, or loss from owning and maintaining place horses. Okay. So to carry forward such losses, it is mandatory the return is furnished within the time limit. But loss under house property or unabsorbed depreciation can be carried forward even if return is furnished after the due date. Okay. The losses under a PGBP or capital gain can be set off even if the return is furnished after the due date. It applies only in the year. The requirement to furnish return of income within a due date applies only in the year in which the loss originates. Second type of return, 139(4), belated return. If return is not filed within a due date, then it may be filed within 3 months before the end of relevant assessment year or before completion of assessment, whichever is earlier. Revised return. The original return or the belated return both can be revised. So a return funded under section 139(1) or 139(4) may be revised to correct any omission or wrong statement therein at any time before 3 months prior to the end of relevant assessment year or before completion of assessment, whichever is earlier. Defective return, 139(9). Where AO considers the return furnished by assessee is defective. So if any return furnished by the assessee is considered to be defective, then the assessing officer shall intimate the defect to the assessee and give him an opportunity to rectify the defect within 50 days from the date of such intimation. The above period of 15 days can be extended on the request of the assessee. However, if defect is not rectified within the 15-day period or extended period as the case may be, the return shall be deemed to have never been filed. Okay. However, AO may condone the delay if defect is rectified after the aforesaid period but before completion of assessment. When a return of income is deemed to be defective, so it's theoretical. Nowadays, it's a electronic return. So most of these defects are considered while filing return of income itself by the software. So if return is not accompanied by the annexure statement or column relating to the computation of income, and each head of income have not been duly filled in, or return is not accompanied by statement showing computation of tax payable, tax audit report, cost audit report, proof of TDS and TCS. All these details are now electronically furnished, and this is a paperless return, so no documents are attached. The proof of payment of tax under section 140B. So the return is an updated return. So self-assessment test in case of original return does not make a return defective. But if the proof of payment of tax in case of updated return is not furnished, then such updated return shall be treated as defective. If regular books of account are maintained, the return should be accompanied by copies of manufacturing account, trading account, P&L account, or income expenditure account, or the similar account and balance sheet. Personal account of partner or member, as the case may be. But where regular books of account are not maintained, the return is accompanied by a statement indicating the amount of turnover, gross profit, gross receipts, gross profit, expenses, and the net profit. And in respect of balance sheet, debtors, creditors, stock, and cash balance at the end of the previous year. Lastly, there is a modified return. So there is a business reorganization with effect from a retrospective date. Okay. So as and the return for such period has already filed by the predecessor. The successor is required to furnish a modified return. Such modified return is to be furnished within 6 months from the end of the month in which the order was issued. Okay. If any assessment has already been done on the basis of original return, then the AO is required to modify the assessment in accordance with the order and order of business reorganization and the modified return so furnished. If any assessment is ongoing, then before passing the order, the AO is required to take into account the order of business organization and the modified return so furnished. These are different types of returns. 139.1 mandatory return, which will be filed by the due date of 31st July, October, or 30th November. 139.3 loss return. It says the loss under PGBP capital gain and owning and maintaining resources cannot be carried forward if the return of such year is not furnished within the due date. 139.4 is a belated return up to 3 months before the end of relevant assessment year. That is 31st December of the assessment year. 139.5 revised return. Again, 31st December of the assessment year before completion of assessment, whichever is earlier. 139.8A, which we will study in a minute, updated return. It can be filed up to 48 months from the end of the relevant assessment year. And 139.9 defective return. Defect is rectified within 15 days from the date of intimation of such defect or any period studied by the AO. 170A, the modified return. It has to be filed within 6 months from the end of the month in which the order of business reorganization is received or is issued. So these charts are helpful for revision. Now, what is the panel consequence for not filing the return of income on time? So first is there is a fee under section 234 Act. So if any person who is required to furnish return of income does not furnish the return of income within time, then he is required to pay a fee of rupees 5,000. However, fee shall only be 1 lakh. The total income does not exceed rupees 5 lakh. If total income is up to 5 lakh, the fee is 1,000. If total income is more than 5 lakh, then the fee is 5,000. If return is not furnished within time, then there is also interest liability in section 234A. Interest is payable at the rate of 1% for every month or part of the month. The interest payable from the due date, from the day immediately after due date of furnishing return of income. If the return of income is filed, then up to a date of furnishing return of income. If not filed, then up to a date of assessment. Amount on which this interest is payable is the amount computed under intimation under section 143(1) or order as reduced by advance tax, TDS, TCS, any relief under section 89, 90, 90A, 91, MAT or AMT credit, or self-assessment tax is paid before the due date of return of income. If return is not furnished within a due date, then also there is a penalty under section 272A equivalent to the 500 rupees per day. The such penalty is levied only if the return was required to be furnished under section 194A, which is applicable to charitable religious trust, or 194C, which is applicable to some institutions which are exempt under section 10. Of course, 139.3 says that if return is not furnished within time, then some of the losses are not allowed to be carried forward. So this is the penal consequences. There is a fee 5,000 or 1,000. There is an interest under 234A. The loss Carry forward loss is not allowed. Deduction under section 10AA because and part C of chapter 6A are not allowed because such section says that the deduction shall be allowed only if the item is furnished within a due date. Of course, if you want to opt out from the default tax regime, then you have to opt out by within the due date by filing the option within the due date. And certain deduction means part C deduction under chapter 6 are not allowed. So this is exhaustive, all penal consequences. Okay. Following person are also required to furnish return of income. So 139(4)(a) is applicable for charitable religious organization. The due date is 31st October as filing of audit report is mandatory. When they are required to furnish, if their gross receipts exceeds the basic exemption limit, if total income without giving effect to the provision section 11 and 12 exceeds the basic exemption limit, if the return is not filed by the due date, then they are liable for C under section 234F, interest 234A, and also penalty under section 272A equivalent to 500 rupees per day. Political party are also required to furnish return of income by 31st October because in this case also the audit is mandatory. They are required to furnish return of income if their gross receipt without giving effect to the provision section 13A exceeds the basic exemption limit. If it is not filed, then there is a C under section 234F and interest under section 234A. Then there are some association institutions whose income are exempt under section 10. They are also required to furnish return of income if their total income without giving effect to the provision of section 10 exceeds the basic exemption limit. If the return is not furnished within time, then the penal consequences shall apply, which is C 234F, interest 234A, and also penalty of 500 per day under section 272A. Okay. The duty of filing return of income in this case is 31st October if they are required to get their books of account audited, or 31st July in any other case. Okay. The penalty of 500 per day under section 272A is applicable only in case of charitable institution or these association institutions whose income are exempt under section 10. The returns of funds under section 139(4)(a), 4(b), or 4(c) shall be deemed to be return filed under section 139(1). Person exempted from filing return of income. These persons are exempted from filing return of income. Who are these persons? They are non-resident or a foreign company. So, non-resident or foreign company is not required to furnish return of income if it has only income from investment fund located in IFSC and tax under section 194 LLBB has been deducted at source and remitted to the central government by the investment fund. Then no other amount is payable by such NR or foreign company, and there is no other income. However, they shall be required to furnish return of income if any notice has been issued under section 142(1), 148, or 153A. This non-resident foreign company is not required to furnish return of income if they have only income from investment in specified fund, so such income is exempt, and there is no other income. And provision of PAN under section 139AA is not applicable. Also, an NR is not required to furnish return of income if it has income from transfer of capital assets referred to in section 47(7)(ab), meaning bonds or GDRs under section 115AC or rupee denoted bond of an Indian company, derivative or other notified securities, which are listed. These assets are listed on Economic Stock Exchange located in IFSC, and the consideration of transfer is paid in foreign currency. If there is no other income of such NR and the provision of section 139AA is not applicable to it, then such NR is also not required to furnish return of income. But if you are not furnished return of income, then you must give these particulars. What are these particulars? You must state the name, email ID, and contact number, address of the country in which you are resident, a declaration that you are a resident of a country outside India, and tax identification number or unique number in such country, in the country of his residence. Okay. So a non-resident or a foreign company is not required. They have income from IFSC. Income as discussed above. Now, TRP, tax return preparer. So the scheme launched by the central government, wherein central government has authorized, has notified some TRPs who assist the public to file return of income. So who can a TRP? Only an individual can be a TRP, and such individual should hold a bachelor degree from recognized Indian university or institution, or has passed the intermediate level of examination conducted by ICAI, ICSI, and ICMAI. So inter pass होना चाहिए, inter pass, or a BCom graduate, bachelor graduate. Who cannot be a TRP? An officer of scheduled bank with which the assessee maintains a current account or has as a regular dealing, a lawyer, a chartered accountant, or employee of eligible assessee. Means your own employee cannot file your return as a TRP. Who can get the return filed through TRP? Who are the eligible employees? So any person being an individual HUF. But individual HUF cannot use the service of TRP if their accounts are required to be audited under Section 44AB or under any other law for the time being force, or they qualify as non-resident. Self-assessment tax. This is to be paid at the time of filing return of income. Assessee is required to pay self-assessment tax computed as under before filing return of income. Though not attaching a proof of self-assessment tax doesn't make a return defective. Tax computed on return of income as reduced by tax already paid, TDS, TCS, any relief under Section 89, 90, 90A or 91, MAT or AMT credit. The amount so remaining has to be paid at the time of filing return of income, and this amount is called self-assessment tax. Okay. Assessee is required to pay self-assessment tax along with interest and fee. The fee which we studied in Section 234F, interest 234ABC. Okay. So if you are filing return of income late, then you are required to pay a fee of 5,000, 1,000 as the case may be. Return shall be accompanied by the proof of such tax, interest, and fee. If assessee fail to pay any such tax, interest, or fee, then it shall be deemed to be assessee in default in respect of such tax, interest, or fee remaining unpaid. Where the amount paid by the assessee falls short of the aggregate of the tax, interest, and fee, the amount so paid shall first be adjusted towards the fee. The balance amount shall then be adjusted towards interest, and the remaining amount shall then be adjusted against the tax. Now we come to updated data. Okay, this is important from your exam point of view as well. Section 139(8)(a). So it says any person can furnish an updated return within 48 months from the end of relevant assessment year. The updated return can be filed whether the assessee has earlier filed the original return or not. The updated return shall be deemed to be defective if it is not accompanied by the proof of payment of tax under Section 140B. Okay. So while filing updated return, it is mandatory that there is a payment of tax under Section 140B and a proof is attached. Interest under Section 234A, B, and C shall be computed with reference to tax declared in updated return. Obviously logical hai. Okay. If any loss on another depreciation has been reduced in the updated return, then it is mandatory to update the return of subsequent year as well, because in subsequent year you must have set off such loss on another depreciation which was at first place is not available because you have reduced it in the updated return. If the loss on absorbed depreciation or tax credit carried forward is to be reduced for any subsequent previous year as a result of furnishing updated return of income for a previous year, an updated return is required to furnish for each such subsequent previous year. Exception. An updated return cannot be filed if the updated return is a return of loss. So updated return is filed only for the benefit of government. It cannot be filed for the benefit of the assessee. So it cannot be filed, which is a loss return. or has the effect of decreasing the total tax liability determined in the basis of earlier return furnished for such assessment year. So you cannot reduce your tax liability which you determined in the earlier return. And in an updated return, you cannot result in a refund or cannot increase the refund due on the basis of any earlier return furnished for such assessment year. Also, an updated return cannot be filed for the relevant assessment year where an updated return has already been filed, meaning an updated return cannot be revised, or where any proceeding for assessment or assessment is pending or has been completed in respect of such year. If the assessment has been started or completed, then you cannot file the updated return. If any proceedings have been initiated, then updated return cannot be filed. If an information for such assessment year has been received under section 90 or 90A, and such information has been communicated to the assessee, then in such case, the assessee cannot update the return. Now, since the department has received some information under section 90 or 90A from the outside country, and such information has also been communicated to the assessee, then it's a case of a penalty. You cannot update your return. Similarly, if assessing officer has any information in his possession under the Smuggler and Foreign Exchange Manipulator for Future Property Act or PMLA or Black Money Act or Prohibition of Benami Property Transaction Act, and the same has been communicated to the assessee, then also you cannot update your return. Whatever the proceeding which the AO can take, he will take. Or the assessee belongs to such class of person as may be notified by the CBDT in this regard. Again, an updated return cannot be filed for the assessment year relevant to the previous year in which such is initiated or survey is conducted or acquisition made, and for any assessment year preceding to such year. Okay. Where such has been initiated in section 132, or books of account or other document are acquisition in section 132A, or survey has been conducted in section 133A, but does not include a TDS or TCS survey. So even a TDS or TCS survey has been conducted, the assessee can file the updated return. Or where notice has been issued to the effect that any money, bullion, jewelry, or other valuable article or thing seized or acquisition in a case of any other person belong to such person, or books of account or the documents seized in the case of any other person belong to, pertain to such person, then also such person cannot file the updated return. The updated return shall be furnished, no updated return shall be furnished by any person where notice under section 148A has been issued in his case after 36 months from the end of relevant assessment year. If the notice under section 148A for income escaping assessment has been issued after the expiry of 3 years from the end of relevant assessment year, then in such case you cannot furnish your updated return. However, in such case, the updated return can be filed if subsequently to the issue of such notice, an order is passed determining that it is not a fit case for issue of notice in section 148. Then in such case, you can furnish the updated return, but within the time limit of 48 months from the end of relevant assessment year. Okay. So this was all about updated return, when we can file, when we cannot file, and what is the timeline. Now, as we discussed, along with the updated return, you have to pay tax, interest, fee, and additional tax. So updated return is not free of cost, there is an additional tax. So how the tax is computed? Tax computed on the income declared in the updated return. Add any interest under section 234A, B, or C. Such interest is to be computed on the basis of income declared in the updated return. Add C under section 234F. Then reduce any advance tax, TDS, TCS, relief under section 89, 90, 90A, 91, any MAT or AMT credit, any self-assessment tax paid under section 140A or any interest paid in earlier return. So this gives the amount which is to be paid as along with the updated return. You have to add any refund if any issued in consequence of your earlier return. Proof of self-assessment tax paid under Section 140B is required to be submitted along with the updated return. Otherwise, updated return is considered as defective. Okay. Now, how you compute the additional tax? Additional tax depends upon when you are filing the updated return. If the updated return is filed within 12 months from the end of regular assessment year, then the additional tax is 25% of tax plus interest. If the updated return is filed after the expiry of 12 months but before the expiry of 24 months, then the additional tax is computed at the rate of 50% of course, the same amount of the 50% of the tax and the interest. If the updated return is filed after 24 months but before 36 months, the additional tax is paid at the rate of 60% of the tax and interest. If updated return is filed after 36 months but before 48 months, then the additional tax is paid at the rate of 70% of the tax and interest. So, firstly, 25% within a year, within a 2 year, 50% double, then for every year, 10% increment. So 25, 50, 60, and 70. If the return is filed after 1 year, 2 year, 3 year, 4 year, as the case may. Now, who all are persons who are authorized to authorize the return of income, to sign the return of income? In case of individual, who shall authorize the return? The individual himself. However, if he is absent from India, then he himself or any person authorized by him. However, he is mentally incapacitated, then any of his guardian or any person competent to act on his behalf. If for any other reason the individual is not able to sign, then any person authorized by him shall sign the return. In case of HUF, the Karta. However, if Karta is absent from India or is not able to sign, then any other adult member may sign. In case of partnership from the managing partner. However, if there is no managing partner is not able to sign, then any other partner not being minor. In case of LLP, designated partner, where the designated partner is not able to sign or there is no designated partner, then by any partner thereof or any person as may prescribed. We'll discuss in a minute. Okay, let's see. Who is the person which is prescribed? Meaning, if a company or LLP has gone into the insolvency, then the resolution professional or a liquidator may sign the return of income on behalf of LLP or the company. In case of company, the managing director, where the MD is not able to sign or there is no MD by any director thereof or by any other person as may prescribe. Prescribe is same as we discussed for the LLP. In case of NR company, non-resident company, MD or a person holding valid power of attorney from such company. So any person who holds a valid power of attorney can sign on behalf of the NR company. So even a CA in India can furnish a return of a foreign company if he has a valid power of attorney from such foreign company, authorizing him to sign the return on its behalf. However, in case of Indian company, only the MD or any other director can only sign. No other person can be authorized. If company is under liquidation, then who will sign? The liquidator, of course. Company whose management has been taken over by the government, then the principal officer. Company whose application has been admitted under the insolvency bankruptcy corp, the insolvency professional. Local authority, in case of local authority, principal officer. In case of political party, chief executive officer. Any other person competent to verify. And 139A. So, not much relevant from exam point of view, but will complete from the completeness point of view. So, following person are mandatorily required to obtain PAN on or before 31st May of the assessment year or immediately succeeding financial year. Who, if his total income or total income of any other person in fact of which he is assessable exceeds the basic assumption limit, or being a resident other than individual which enter into any financial transaction of an amount aggregating 2.5 lakh or more in a financial year, such person must obtain a PAN. Or if he is a managing director, partner, trustee, author, founder, karta, chief executive officer, principal officer, or any office bearer of the person referred in point 2 above, or any person competent to act on behalf of the person referred to in point 2 above. Okay. So point 2 is applicable only in case of resident. Then following person required to obtain PAN before the end of the financial year. If his total turnover the business perfection exceed or likely to exceed rupees 5 lakh in the previous year, or if he is required to furnish return of income under section 134A. 4 is was applicable for charitable and religious institution whose total income without giving effect to the provision of section 11 and 12 exceeds the basic assumption limit. Following person required to obtain PAN on or before 7th days before the event. Which is the event? If they deposit or withdraw cash in his one or more account with the bank, if the aggregate amount of cash deposit or withdrawn in such account during a financial year is 20 lakh or more, or if he opens a current account, then he must obtain a PAN at least 7 days before the date of opening of the current account. Central government may notify any person or class of person who shall apply for allotment of PAN. The AO, having regard to the nature of transaction as may prescribe, allot a PAN to any other person. Central government may notify any class of person who shall apply for allotment of PAN. Further, any person can voluntarily apply for PAN. So it's not mandated. It's not necessary that only prescribed person can obtain PAN. Anybody can obtain PAN. So even if you do not fall under any of the above category, you can voluntarily obtain PAN. Now, quoting of PAN is mandatory in the following documents. In any correspondence with the income tax department, including return and challan, while opening a bank account other than time deposit or a demat account, making an application for issue of credit or debit card, sale or purchase of motor vehicle other than two-wheeler, sale or purchase of securities or unlisted shares for an amount exceeding rupees 1 lakh per transaction, sale or purchase of immovable property for an amount exceeding rupees 10 lakh, or if the stamp duty value of such property exceeds rupees 10 lakh, single payment in cash for an amount exceeding 50,000 to a hotel, or in connection with foreign travel of purchase or for purchase of foreign currency, payment of an amount exceeding 50,000 to a mutual fund for purchase of its units or to a company for acquiring debenture or bond, cash deposit exceeding 50,000 in a bank in any one single day, cash withdrawal from one or more account in a bank if the aggregate of the amount of cash deposit or withdrawal during a financial year is 20 lakh or more. If he opens a current account, he is mandatory to quote his PAN to the bank. Payment in cash of an amount exceeding 50,000 during any one day for purchase of bank draft, purchase of time deposit FDs for an amount exceeding 50,000 or aggregate of amount more than 5 lakh in a financial year, payment of amount aggregating to more than 50,000 in a financial year as a life insurance premium, sale or purchase by any person of good or service of any nature other than those referred above for an amount exceeding 2 lakh per transaction. Okay. If his tax is directly or collected at source. Every person directly or collecting tax shall quote the PAN of directly or collecting the certificate issued and return furnished by it. So the director or collector is mandatory required to furnish the PAN of the director or collecting in the TDS and TCS certificate, also in the TDS and TCS return. Where any of the above transaction is undertaken by a minor having nil taxable income, PAN of his parent or guardian shall be quoted. Quoting of PAN is not required if the transaction by the government or non-resident. Also, PAN and Aadhaar are substitute. So every person who is required to furnish PAN may furnish Aadhaar also in lieu of PAN. Penalty in case of default is relating to PAN. Failure to comply with the provision section 139A, meaning if you don't obtain pen when you're required to, or you don't quote pen where you're required to, then there's a penalty of rupees 10,000. If there's a failure to quote pen in any document referred to in 139A, then 10,000 per default. Failure to intimate PAN or Aadhaar to person directing or collecting tax, again a penalty of 10,000 per default. Or if you knowingly quote a wrong PAN, then there also a penalty of 10,000 per default. Now 139AA Aadhaar number. Every person who is eligible to obtain Aadhaar shall quote the Aadhaar in the PAN application for allotment of PAN and the return of income. Now, quoting of Aadhaar is mandatory. Quoting of enrollment entity will not suffice. Every person who has been allotted PAN and who is eligible to obtain Aadhaar shall link the Aadhaar with PAN by 31st March 2022. If it is not linked, then there is a penalty in 234 and PAN shall become inoperative. You will not be able to get the interest on refund or interest, and in your case, the PAN tax shall be deducted or collected at a higher rate. PAN once become inoperative will become operative within 30 days from the date of intimation of Aadhaar number. A person who failed to link his Aadhaar up to 31st March 2022, he would liable to pay a falling fee at the time of making Aadhaar, linking Aadhaar after said date. 500 in case linking done up to 30th June 2022 and 1,000 all other cases. However, Aadhaar and PAN link is not mandatory for the following person. Why? Because following person are not mandatory required to obtain Aadhaar in the under the law Aadhaar law. Okay. Who all are these persons? Any person residing in Assam, Jammu and Kashmir or Meghalaya, a non-resident as per the Income Tax Act. Any person who is of the age of 80 years or more at any time during the previous year. Or any person who is not a citizen of India. These four category of person are not required to link their PAN with others. Now, this completes the return of income. Now we are moving to assessment procedure. Okay. So first is inquiry before assessment under section 142(1). So AO may issue a notice to any person who has furnished a return of income or in whose case time allowed under section 139(1) has expired and he has not furnished a return of income. So notice may require him to furnish return of income again, or if not furnished earlier, then furnish return of income, or to produce such account document as the AO may require, or to furnish such other information, including statement of asset and liability, including the personal assets, whether including books of account or not, as the AO may require. However, the AO shall obtain the previous approval of Joint Commissioner before requiring the assessor to furnish statement of all asset and liability, not including the books of account. Account related period prior to 3 years. Prior to the previous year cannot be asked for under section 142(1). 142(2) says, for the purpose of obtaining full information in respect of income or loss of any person, the AO may make such inquiry as he considers necessary. So, notice under section 142 can be issued requiring assessor to furnish return of income if such return of income has not been furnished and the assessment has already within a due date or before the end of assessment year. Such notice may require the person to produce accounts or document. However, accounts or document for a period prior to 3 years before the previous year cannot be asked. Notice can ask the person to furnish any other information as the AO may require, and such information may include a statement of asset and liability, whether such statement is part of books of account or not. However, prior approval of Joint Commissioner is required to ask for the statement of asset and liability not included in the books of accounts, meaning to ask for the personal assets and liabilities. Now, 142(2)(a) direction for special audit. Okay. So the during the course of any proceeding, AO may at any stage of proceeding before him, with the previous approval of Principal Chief Commissioner, Principal Commissioner, Commissioner, and after giving the assessee opportunity of being heard, direct the assessee to get his books of account audited from a CA, which is nominated by these Principal Chief Commissioner, Commissioner, or Principal Commissioner, or may direct the assessee to get the inventory valued by a cost accountant, again nominated by these senior person. AO may direct special audit or inventory valuation having regard to the interest of the revenue, if and nature and complexity of the accounts. So AO feels that nature and the complexity of the account are as such that they are required to get them special audit, or having regard to the volume of the account. If accounts are voluminous, if he has doubt about the correctness of the account, or the multiplicity of transaction in the accounts, or because of specialized nature of business activity of the assessee. For any of these reasons, the AO may ask the assessee to get books of account audited or to get the inventory value from a cost accountant. Assessee shall furnish the report of such audit or valuation within such time as may be specified by AO. And AO may suo motu or on assessee's application extend the period of furnishing the report. However, the aggregate period cannot in any case exceed 180 days, 6 months, from the date of receipt of direction by the assessee. Now, expense of such audit. The expense of such audit is borne by the central government. Expenses of such audit or valuation, including remuneration of a chartered accountant or cost accountant, shall be determined by the senior officer as per prescribed guidelines, and expenses so determined shall be paid by the central government. Assessee shall not be liable to consequences for failure to get account audited if the nominated chartered accountant refused to audit the accounts of the assessee. Now, reference to a valuation officer under section 142A. The AO may, for the purpose of assessment or reassessment, make a reference to the valuation officer to estimate the value of any asset and submit a copy of report to him. The valuation officer shall estimate the value of the asset after considering such evidence as the assessee may produce, or he may gather after giving the assessee an opportunity of being heard. The valuation officer shall send the copy of the report to the AO and the assessee in a period of 6 months from the end of the month in which reference was made. The AO may, after giving the assessing opportunity of being heard, consider such report in making any assessment or reassessment. Okay. So that during the course of making assessment if the AO requires, he can make a reference to the valuation officer to determine the fair market value of any property. And in such case, the valuation officer shall submit the report within 6 months from the end of the month in which the reference is made. Okay. So last section before the break, processing of return. Then we'll have a small break. Under section 143.1. A return furnished by the assessor in section 139 or in response to under section 142.1 shall be, so it's mandatory to be processed by the CPC Central Processing Cell to make following adjustments. Any arithmetical error in the return, or an incorrect claim which is apparent from any information in the return, that is a claim on the basis of an entry in the return of an item. So any incorrect claim which is very much apparent from the information in the return itself. If any item which is inconsistent with another entry in the return, or in respect of which the information required to be furnished under the Act is not furnished, or in respect of deduction where such deduction exceeds the specified limit. Any such inconsistency in the return with respect to information in the return of any preceding previous year as may prescribe, disallowance of loss claimed in the return of the year in which such loss originated was furnished after due date, disallowance of any expenditure indicated in the tax audit report, or disallowance of deduction section 10AA of part C of chapter 6A if the return is furnished after the due date. Okay. All this adjustment can be made at the time of processing of return of income. Any arithmetical error and incorrect claim which is apparent from the return, or Any inconsistency compared to the return furnished for earlier years. Disallowance of loss if such loss to be return of the year of income such loss was furnished after due date. Disallowance of any expenditure indicated by the tax auditor, or disallowance of deduction if the return of current year is furnished after the due date. In case of processing of return, intimation is sent to the assessee specifying the sum payable or refund due to him in both cases. However, no adjustment shall be made unless an intimation is given to the assessee. If any of the above adjustment is required, then for such, it is necessary that the intimation is given to the assessee. And the response so received from the assessee shall be considered before making such adjustment. However, when no such response is received within 30 days of issue of such notice, such intimation, the adjustment shall be made. Intimation is also sent if loss declared in the return is adjusted, but no sum is payable or no refund is due to the assessee. The time limit of filing of passing the intimation shall be sent after the expiry. No intimation shall be sent after the expiry of 9 months from the end of the financial year in which return is furnished. So that intimation is sent up to 31st December. Okay. 9 months from the end of the financial year in which return is furnished. However, if no intimation is sent, meaning if there is no processing of return, then the acknowledgement of the return is considered, is deemed as intimation if no intimation is received by the assessee. Okay. These were the basic provisions for the assessment. The inquiry in section 142, the special audit, valuation, reference to valuation officer, and processing of return. Now, after a break, we'll start with the normal assessment procedure. So there are 4 types of assessment: the scrutiny assessment 43.3, the best judgment assessment 44, income escaping assessment 47, and the assessment case of search. We will discuss in detail, we will devise in detail the provision applicable in all of these assessments. Okay. So we have a break for 10 minutes and we'll again assemble on 7:37. Okay. Now we'll start with the assessment procedure. So first assessment, the scrutiny assessment. Notice for which is issued under section 143(2) and the assessment is made under section 143(3). So it's there. Scrutiny assessment can be made only if the return has been furnished. So where return has been furnished, the AO may serve on the assessee a notice requiring him to produce any evidence on which he may rely in support of the return. Such notice is to be served up to 3 months from the end of the financial year in which return is furnished. There is normal case up to 30th June. Okay. In scrutiny assessment, AO shall, by an order in writing, assess the total income or loss of the assessee on the basis of evidence produced by the assessee and material gathered by the AO, and determine the sum payable by assessee and or also any refund due to him on the basis of such assessment. So AO shall determine the any amount payable or any amount of refund due to the assessee. So even under section 143(3) assessment, assessee can get the refund also. Okay. We discuss that association, institution, body who are exempted under section 10, they were required to furnish under section 139(4)(3) if their total income without giving effect to the provision of section 10 exceeds the basic exemption limit. But now, if during the course of assessment, if the AO found that they have not complied with the condition of some condition in which they were approved, by virtue of which they were claiming exemption of section 10, then he cannot himself deny the exemption of section 10 unless the approval is withdrawn. So what he will do, while making the assessment on person referred to in section 139(4)(c), AO shall not disallow the exemption of section 10 unless AO has intimated central government or the prescribed authority. Who is the central government prescribed authority? Because these approvals are given by the central government or prescribed authority as the case may be. So AO has intimated authority. Only once the approval is withdrawn, only then the AO can deny the exemption under section 10 to these institutions. Okay. Similarly, in respect of institution referred to in section 35, AO shall recommend to the central government to withdraw the approval granted to the institution referred to in section 35 after giving opportunity of being heard to such institution, if we consider that the activities of such institution are not being carried out in accordance with the conditions subject to which approval was granted. So during the course of assessment, if AO finds that the activities of the institution are not being carried out as per the condition of the approval, then he cannot withdraw the approval. He can only refer the case to the person who has given the approval, and such person shall check and then withdraw the approval. However, before referring the case, he shall give an opportunity of being heard to the assessee. Sure. Now, in case of charitable religious trust, if any trust or institution referred to in section 1023(c) or 11 has committed any specified violation, the AO shall send a reference to principal commissioner or commissioner to withdraw the approval, because the registration is also given by these authority only. And AO shall pass order after giving effect to the order of principal commissioner or commissioner, either cancelling the approval or refusing to cancel the approval of such trust, as the case may be. Okay. Whatever this specified violation on account of which the AO shall refer the case to the PCIT or CIT. So, if the income of the trust derived from the property held in a trust is applied other than for the object of the trust or for private religious purpose which does not inure to the public at large or for the benefit of any particular religious community or caste, the trust or institution has income from business which is not incidental to the attainment of the object of the trust, or separate books of account of which are not maintained in respect of such business. or any activity being carried out by the trust which is not genuine, not being carried out in accordance with all or any of the conditions subject to which it was registered, or trust has not complied with the requirement of any other law, and the order, direction, or decree by whatever name called, holding that such non-compliance has occurred, has either not been disputed or has attained finality, or whether the registration application filed by the trust is incomplete or contain false or incorrect information. In all these cases, rather in any of these cases, the AO shall refer the case to the PCIT or CIT. So if AO come across any of these events while assessment of charitable religious institution, then he can refer the case for withdrawal to the CIT or PCIT. Okay. Best judgment assessment, section 144. Assessment to the best of the judgment of the AO. If any person, when 144 can be invoked, if any person fail to furnish return of income or to comply with the notice issued in section 142(1) or 143(2) scrutiny notice, or to comply with the direction issued for special audit or inventory valuation under section 142A. If in case of any of these default, the AO shall by order in writing assess the total income or loss of the assessee to the best of his judgment ex parte on the basis of material gathered by him and determine the sum payable by the assessee. There is no refund due to him on the basis of such assessment. So, if an assessment made under section 144, refund cannot be issued. AO shall give an opportunity on being heard to the assessee to show cause as to why an assessment should not be completed to the best of his judgment. However, such opportunity shall not be required if notice in section 42 has already been issued. Okay. Now, 144A, direction by the Joint Commissioner. The Joint Commissioner may, on its own motion, or on request of the assessing officer, or on request of the assessee, in any of these three cases, he can issue such direction to the AO as it thinks fit for the purpose of completing the assessment, and such direction shall be binding on the AO. However, no direction prejudicial to the interest of assessee shall be issued before an opportunity of being heard is given to the assessee. Okay. Now the third assessment, income escaping assessment. Section 147. But before 147, the procedure of section 148 and 148A has to be complied with. So where AO has information which suggests that income has chargeable tax has escaped assessment, then he shall provide such information to the assessee and serve upon him a show cause notice as to why a notice under section 148 should not be issued in his case. So if he has some information which suggests that income has escaped assessment, he will provide such information to the assessee and show cause him that as to explain, as to show cause why a notice under section 148 should not be issued in his case. Because if a notice is issued under section 148, then assessment under section 147 is initiated. On receipt of the notice, the assessee may furnish reply within such period as may be specified in the notice. The AO, on the basis of material available with him and taking into account the reply furnished by the assessee, pass an order with the prior approval of specified authority. We'll see who is the specified authority, determining whether or not it's a fit case for issue of notice under section 148. The provision of this section, this exercise of giving opportunity to the assessee to show cause as to why a notice under section 148 should not be issued. This exercise, this opportunity is not required if where the AO has received the information under the scheme notified under section 135. Information which suggests that income chargeable to escape assessment means any information in the case of the assessee in accordance with risk management strategy formulated by a board from time to time, or any audit objection to the effect that assessment has not been made in accordance with the provisions of the Act. All these cases form part of the information which suggests that income has escaped assessment, and therefore the case of the assessee can be opened under section 147. Any information received under an agreement referred to in section 90 or 90A, Any information made available to the AO under section 135A. In this case, even the issuance of notice under section 135A under section 148A is not mandatory. Any information which require action in consequence of order of tribunal or court, or any information emanating from a survey conducted in section 133A other than TDS or TCS session. Okay. Notice for making assessment or reassessment. Section 148. AO shall issue a notice along with a copy of the order in section 148A on the assessee, a notice requiring him to furnish return of income within such period as may be specified in the notice. Okay. Period allowed in the notice of furnishing return of income cannot exceed 3 months from the end of the month in which such notice is issued. Such return is considered to be returned under section 139, return furnished under section 139. However, where the return is furnished after the period allowed in the notice, such return will not be deemed to be a return under section 139, and accordingly, AO may proceed with best judgment assessment. Where AO has received the information in section 135A, notice in section 148 shall be issued after obtaining the approval of specified authority. Why? Because in this case, there will be no 148A, so there will be no approval of specified authority by the time of passing of order in section 148A. So now, if there is no 148A, the approval of specified authority shall be obtained at the time of issue of notice in section 148. In all other cases, such approval is obtained at the time of passing of order in section 148A. Okay. Admit for issue of notice in section 48A and 148. When income chargeable to which has escaped assessment or as per the information with AO likely to amount to 50 lakh or more, then we have 5 years. Notice in section 148A has to be issued within 5 years from the end of revenue assessment year. And in that case, notice in section 148 can be issued up to 5 years and 3 months from the end of revenue assessment year. In any other case, the notice under section 148A can be issued up to 3 years from the end of revenue assessment year. In such case, the notice in section 148 shall be issued up to 3 years and 3 months from the end of revenue assessment year. However, in following cases, notice in section 48 can be issued any time in consequence of to give effect to the finding or direction contained any order passed by any authority or court in any appeal or division. So to give effect to any direction of finding contain any order passed by any court or authority, the notice in the section 48 can be issued anytime. There is no time limit. However, the above provision shall not apply if notice for such as could not have been issued at the time of the order which was subject matter of appeal or revision. So if notice for this year or on this person could not have been issued at the time such order was passed, then now also notice in section 148 cannot be issued. Following are deemed to be the cases where assessment is to be made in consequence of or to give effect to the finding or direction contained order passed by any authority or court in any appeal or division. So what are these facts? Where the appellate authority or the court held that the income which is subject matter of appeal is not to be assessed in the assessment year, the relevant assessment year, imputed assessment year, but to be assessed in any other assessment year. Then the notice for such other assessment year can be issued at any time. Or if it is held that the income is not to be assessed in the hands of the assessee but in the hands of any other person, then notice to assess such income in the hands of such other person can be issued anytime. Okay. So what are these cases? Where any income is excluded from total income of assessee for an assessment year, then an assessment for such income for another assessment year shall be deemed to be one made in consequence of to give effect to the order of direction contained in said order. Where any income is excluded from total income of one person and held to be the income of another person. Sorry. Then assessment of such income on such other person shall be deemed to be the one made in consequence or to give effect to the order or direction contained in the said order, if such other person was given an opportunity of being heard before the said order was passed. Okay. Now, who is specified authority as referred in section 148 or 148A? So, specified authority for the purpose of section 148 shall be additional commissioner or additional director or joint commissioner or joint director, as the case may be. Tax shall be charged at the rate applicable for the assessment year for which assessment is made. Okay. In case of reassessment under section 147, assessee may claim for dropping of such proceeding. Okay. If there is a initiation of proceeding under section 147, then if assessee can prove that he has already been taxed on the income which is likely to have escaped assessment and he has not furnished a file appeal, then he can request for the dropping of proceeding. So what it says, in case of assessment section 147, assessee may claim for dropping of such proceeding if assessee has not impugned the original assessment order, either under appeal or revision, and assessee shows that he had been assessed on an amount not lower than what he would be rightly assessed for, even if the income alleged to have escaped assessment have been taken into account. However, in the above case, assessee shall not be entitled to reopen matters which have concluded by an order of rectification, or order passed by the court. Doctrine of partial merger. It means AO may also assess any income other than the income involving matter which are subject matter of appeal. So this original assessment order, and assessee has challenged the original assessment order in an appeal, and now subsequently AO finds some other income which was not part of the original assessment order, then he can do 147 for that other income, even if the original assessment order is an appeal, but the matter for which it is in appeal is different from the matter for which 147 order is being passed. Time limit for completing assessments. Scrutiny or best judgment assessment, 12 months from the end of relevant assessment year. However, when updated or returned in consequence to section 119 is furnished, an order under section 143.3 or 144 may be made at any time before the expiry of 12 months from the end of the financial year in which such return is furnished. Income escaping assessment section 147, 12 months from the end of the financial year in which notice under section 148 is served. Fresh assessment by AO or transfer planning officer TPO in pursuance of order of ITAT or order passed by CIT under section 263 or 264, setting aside or cancelling the assessment. So any fresh assessment made in consequence of the appeal order. So such fresh assessment shall be made within 12 months from the end of the financial year in which order is received or passed by the CIT, as the case may be. Where AO is required to pass order modifying the assessment in conformity with the order of TPO, giving effect to the order of direction section 263. Then AO shall pass the order within 2 months from the end of the month in which order of TPO is received by him. Passing appeal effect order by AO or the TPO to give effect to an order passed by any appellate authority, otherwise than by making a fresh assessment, because the time limit for making a fresh assessment is given above. Okay. Now you are passing only appeal effect order. So time limit is only 3 months from the end of the month in which such order is received or passed by CIT, as a case may be. With assessment or reassessment made in consequence of or to give effect to any finding or direction contained any order passed, then such order giving effect to the finding or direction shall pass within 12 months from the end of the month in which such order is received or passed by CIT, as the case may be. Where assessments made on a partner of a firm in consequence of assessment made on the firm, then the order in the case of partner shall pass within 12 months from the end of the month in which assessment order in the case of firm is passed. Okay. In all the above cases, if the case is referred to transfer planning officer in section 92CA, then the above time limit shall be increased by 12 months. In case of appeal effect order, where there is a time limit of only 3 months. Yeah. If such appeal effect, where it is not possible for the assessing officer to pass such appeal effect order within the prescribed time for the reason beyond its control, the CIT may, on its request, allow an additional period of 6 months to give effect to the order. Where order passed by appellate authority And if the order passed by arbitral authority require verification of any issue by way of submission of any document by the assessee, or require an opportunity of being heard to be provided to the assessee, then shall be time allowed to AO for passing appeal effect order shall be the same as allowed to him for passing the order in case of fresh assessment. Shall be as available with him for making fresh assessment, which is 12 months from the end of the financial year in which appellate order is received or passed, as the case may be. However, while computing the above time limit, the following times are excluded. Following period are excluded. The time taken in reopening the any part of proceeding or in giving the assessee an opportunity of reheard in case of change in incumbent of the office of the AO. Period during which the proceeding is stayed by an order of any court. Period commencing from the date on which AO intimates the central government or prescribed authority the contravention of the provision of section 10 during the course of assessment under section 43(3) and ending with the date on which the copy of the order withdrawing the approval is received. So we discussed in case of under section 43(3) scrutiny assessment, the AO refer the case to central government prescribed authority for withdrawal of the approval. Then the period from the date he referred till the date he received the order is excluded. Similarly, for charitable religious institution, the period commencing from the day where the AO make a reference to the principal commissioner or commissioner intimated specific violation made by the trust or institution referred to in section 1023C or in section 11 and ending with the date on which the copy of the order either cancelling the approval or refusing to cancel the approval is received by the AO. Okay? Withdrawing the approval is received by the AO. Period commencing from the date on which AO directs the assessee to get his accounts audited or inventory valued under section 142(2)(a) and ending with the last date on which assessee is required to furnish a report of such audit or inventory valuation. Ending with the last day where the assessee is required to furnish a report. It's not ending on the date of furnishing the report. Or where such direction is challenged before a court. Ending with the date on which order setting aside such direction is received by the CIT. Period commencing from the date on which AO makes a reference to valuation officer and ending with the date on which report of valuation officer is received. Period, but here not exceeding 60 days, commencing from the date on which AO received the declaration of section 158A and ending with the date on which order section 158A3 is passed. What is this section we'll discuss today only. Period commencing from the date on which application made before the board for advance ruling and ending with the date on which order rejecting the application or advance ruling pronounced is received by the CIT. Period not exceeding 1 year, commencing from the date on which first reference for exchange of information is made under double taxation avoidance agreement and ending with the date on which last information received by the CIT. Period commencing from the date on which a reference for declaration of arrangement to be impermissible IAA avoidance arrangement is received by CIT and ending on the date on which the action is issued or an order rejecting the reference is received by the AO. The time period available to AO after excluding the aforesaid period, if any such time period available to the AO after excluding the aforesaid period is less than 60 days, then such remaining period shall be extended to 60 days. So after excluding all this period, at least 2 months shall be available with the AO. The period of 60 days shall be available with the AO to make the assessment. Where the period available to TPO is extended to 60 days under section 92CA and time available to AO is less than 60 days, such remaining period shall be extended to 60 days. Okay. So this was time limit for passing the order, assessment orders or order for making a fresh assessment in pursuance of appealable or appealator order or order to give effect to the appeal effect. Okay. Now notice of demand section 156. Where any tax, interest, penalty, fine or any other sum is payable by the assessee, the AO shall serve upon the assessee a notice of demand specifying the sum so payable by him. Or where any sum is determined to be payable under intimation under section 43(1) or TDS or TCS intimation as the case may be, then such intimation shall be deemed to be a notice of demand. In such case, there is no requirement to issue a separate notice of demand. However, in case of ESOP issued by eligible startup, as referred to in section 80 IAC, the tax on such ESOP shall be paid within 14 days after the expiry of 48 months from the end of revenue assessment year, or 14 days from the date when such securities are sold off by the assessee, or 14 days from the date the assessee ceases to be the employee of the startup, whichever is earlier. Where the amount in respect of which a notice of demand has been issued under section 156 is reduced as a result of order of adjudicating authority under IBC, the AO shall modify the demand payable in conformity with such order and shall thereafter serve on the assessee a notice of demand specifying the sums so payable. However, if such order of IBC has been modified by the NCLT or Supreme Court, the modified notice of demand issued by the AO earlier shall be revised accordingly. It's logical? DRP. So this is alternative appealable route. So we have discussed the assessment. Now we have come to the appeal. Okay. So this is not technically appeal, but this is actually appeal because in case of eligible assessee, here two routes. One option is CIT appeal route. We can file an appeal to the CIT appeal against the assessment order, or the DRP route. We can approach the dispute resolution panel DRP. Okay. An eligible assessee has fallen to option in case AO makes a variation in its return of income. Who is an eligible assessee? The assessee means a non-resident or any person in whose case the adjustment is made on account of order of transfer pricing officer. So in case of eligible assessee, it is mandatory for AO to first forward a draft of the proposed order of the assessee. So he will not issue a final order, he will issue a draft order. To the eligible assessee, if AO proposes to make any variation which is prejudicial to the interest of the assessee. Okay. On receipt of draft order, the eligible assessee shall, within 30 days of such receipt, either file his acceptance to the variation or file the objection to such variation with the DRP. So the assessee has 30 days. Either he will, if he want to accept the variation, or if he want to go for the CIT appeal route. So he will file the acceptance of the variation and get the order finalized. Or if he want to go for DRP, then within 30 days, he will file his objection to the draft order with the DRP. AO shall complete the assessment, that is, he shall pass the final assessment order on the basis of draft order when, if assessee intimates him the acceptance, or if no objection is received within a foresaid period of 30 days. So either if the assessee intimated the objection, then he will finalize the order, or if assessee has not objected within 30 days before the DRP, then also he will finalize the order. Such final assessment order shall be passed within 1 month from the end of the month in which the acceptance is received, or the aforesaid period of 30 days for filing the objection expired. Okay. Proceeding before DRP. So if the assessee chooses the DRP route, he has to file the objection within 30 days. Before issuing any direction, a DRP may make such inquiry as it thinks fit, or cause any such inquiry to be made by any income tax authority and report the result to it. Okay. If the members of the DRP differ in opinion on any point, the point shall be decided on the basis of opinion of the majority. An opportunity of being heard is given to the assessee and to the AO before issuing any direction, which the direction is prejudicial to the interest of assessee or revenue as the case may be. Now, DRP shall issue such direction as it thinks fit for the guidance of AO to enable him to complete the assessment. DRP may confirm the variation, may reduce the variation, and may even enhance the variation proposed in the draft order. So DRP has all the power. But DRP cannot set aside the proposed variation. He cannot ask the AO to make another assessment. He cannot set aside the order and ask the AO to make a fresh assessment. DRP cannot issue any direction for further inquiry or passing of assessment order. Power of DRP to enhance the variation shall include power to consider any matter arising out of the assessment proceeding related to draft order, notwithstanding that such matter was raised or not by the eligible assessee. So even if the matter is not raised by the eligible assessee, DRP can consider it and enhance the valuation. Every direction so issued by the DRP for the guidance of AO shall be binding on the AO. You cannot escape from it. No direction shall be issued after 9 months from the end of the month in which draft order is forwarded to the eligible assessee. Upon receipt of direction, the AO shall complete the assessment in conformity with the direction, because direction are binding on the AO. Now AO is not required to provide any other opportunity of being heard to the assessee because DRP has already provided the opportunity. AO shall pass the final order within 1 month from the end of the month in which such direction is received. Now, against this order of the AO, the assessee can file an appeal to the ITAT. Other points. The provision of this section shall not apply to any assessment or reassessment order passed by AO with the prior approval of Principal Commissioner or Commissioner as provided in Section 144BA. In Section 144BA, it is GAR. So, if the order is passed under the GAR in accordance with the approval of PCIT or CIT, then the DRP route is not available. The provision of because such order is challenged before the ITAT directly. The provision of this section shall not apply to any proceeding related to such cases. DRP. How the DRP is constituted? DRP is a panel constituted by 3 Principal Commissioner or Commissioner constituted by the board for this purpose. Eligible assessee. Who is eligible assessee? Who has an option to go for the DRP route? Means any person in whose case variation arises as a consequence of order of TPO, or any non-resident, not being a company or any foreign company. Such eligibility shall not include person referred to 158BA or the other person referred to 158BD. Now, last assessment in case of such. In case of such, there are 2 important things. One is what is block period. The other is what do you mean by undisclosed income. Let's first see the block period. Block period means 6 years prior to the previous year in which search is initiated, and 1st April of the previous year in which search is initiated up to the day search is initiated. So block period means the period comprising previous year relevant to 6 assessment year preceding the previous year in which search was initiated. It also includes periods starting from 1st April of the previous year in which search is initiated and ending on the date of execution of last of the authorization, conclusion of the search. In the case of requisition of Section 132A, the last authorization shall be deemed to have been executed on the actual receipt of books of account or other document or asset by the authorized officer. Undisclosed income. So you understand the meaning of block period? Now we are moving to undisclosed income. Undisclosed income includes any money, bullion, jewelry, virtual digital asset or other valuable article or thing, or any expenditure, any income based on any entry in the books of account or other documents or transactions, where such money, bullion, jewelry or any other asset or entry in the book of account or the document represent wholly or partly income of property which has not been or will not have been disclosed for the purpose of this act. We discussed this language earlier also. Or any expenses, assumption, deduction, allowances claim which is found to be incorrect in respect of block period. Okay. So if any money, bullion or any entry in the books of account is found which has not been disclosed for the purpose of this act, or any expenditure which is found to be incorrect. Assessment of total undisclosed income as a result of such, Section 158BA. Okay. The search is initiated or books of account of the document requisition in the case of any person, then AO shall assess or reset total undisclosed income of block period. So we are required to assess the total income of the block period in accordance with provision of this chapter. So the assessment shall be made for all the 6 years. The total income other than the undisclosed income of the assessment year relevant to the previous year in which last of the authorization of such is executed shall be assessed separately in accordance with other provisions of the Act. So, where the year in which search is concluded, such year shall be assessed normally under section 143, 144 as the case may be, and not as part of block period. The total undisclosed income relating to the block period shall be charged to tax rate of 60% for such and such, of course, as income of the block period, irrespective of the previous year or year to which such income relates. Okay. So any undisclosed income of the block period shall be charged to the tax rate of 60%. Now, any assessment or reassessment, including reference PPO, in respect of year falling within the block period, pending on the date of initiation of such shall abate. Abate means shall be cancelled, annulled. However, any proceeding of assessment or reassessment for any year falling in the block period for which a notice has been issued during the period commencing on the date of initiation of such and ending on the date of making an order under section 58 BC shall also abate. Okay. If an order made under section 58 BC has been annulled in any appeal, then the assessment or assessment so abated shall stand revived with effect from the date of receipt of order of such annulment. However, if such revival shall cease to have effect if order of annulment is set aside. Where before passing the assessment order in case of such, a subsequent search is initiated, then AO must complete the initial assessment before starting the new one. And where the period for completing the assessment with respect to subsequent search, the new assessment, is less than 3 months, such period shall be extended to 3 months from the end of the month in which the assessment with respect to earlier search was completed. Computation of total undisclosed income of block period, 158 DT. The total undisclosed income block period shall be an aggregate of the following. Undisclosed income declared in the return under section 58 BC and undisclosed income determined by AO on the basis of evidence found as a result of search. However, the following income is not included in the total undisclosed income. So these income are not included as part of undisclosed income. What? The total income determined under section 143(1) or already assessed prior to the date of initiation of search in respect of any of the year comprising in the block period. The total income declared in the return of income filed under section 139 prior to the date of initiation of such in respect of any of the previous year comprising the block period. The total income computed under the provision where return has not been furnished because such income is because the tax has been deducted under section 115A, 115G, or 194P. The income computed by assessing in respect of previous year where due to furnished return of income has not been expired on the date of initiation of such on the basis of entries relating to such income as according to the books of account. So these all are disclosed income, already disclosed. The period from 1st April or the previous year in which such is initiated and ending on the day immediately preceding date of initiation of such on the basis of entries made relating to such income as recorded in the books of account maintained the normal course of for such period on or before the day of immediately preceding the date of initiation of such. The period commencing from the date of initiation of such and ending on the date of execution of last of the authorization of such on the basis of entries to such income as recorded in the books of account maintained a normal course. So if the assessment has already been happened, then income so assessed. The assessment has not been happened, but return has already been filed for such year, then income return. If income is not returned because tax income return of filing return of income was not mandatory because tax has been deducted, so the income so considered while deducting tax. Where the due date has not expired for filing the return of income, then income as per the books of account. In case of previous year where the search is initiated, the income as per the books of account. All this income has already been disclosed, so this does not form part of undisclosed income. losses brought from previous year, prior to the first previous year comprising within the block period, on unresolved depreciation of section 32(2), shall not be set off against the undisclosed income determined in the block assessment year. However, it may be such loss of unresolved depreciation can be carried forward for being set off in the previous year subsequent to the assessment in which block period ends for the remaining period, taking into account the block period, such assessment year, and in accordance with the provisions of the Act. So, no loss on unresolved depreciation can be set off against the undisclosed income of the block period. Where any income required to be determined as a result of such relates to any international transaction or specified domestic transaction under section 92CA, pertain to the period beginning from 1st April of the previous year in which last of the authorization of such was executed, and ending with the date on which last of the authorization was executed, such income shall not be considered for the purpose of determining the total undisclosed income of the block period, and such income shall be considered in the assessment made under other provisions of the Act. In case of firm, no deduction shall be allowed in respect of salary, interest, commission, bonus, or remuneration by whatever name called, paid to non-working partner. No assessment, procedure of assessment under 158 BC in case of such. Similar to 147, the AO issue notice to the person on whom search is conducted or books of accounts are acquisition, requiring him to furnish to file within such period, not exceeding a period of 6 months, 60 days, as may be specified in the notice, a return setting for his undisclosed income for the block period. Prior approval of additional commissioner, additional director, joint commissioner, joint director shall be obtained before issuing a notice under this section. Such return is considered a return furnished under section 139. However, if a return is furnished beyond the period allowed in the notice, then it is not deemed to be a return furnished under section 139. When the assessee failed to furnish the return within a specified time in the notice, or does not furnish at all, the assessee is liable to pay interest at the rate of 1.5% for each month or part of the month thereof on the amount of tax on undisclosed income. The interest shall be charged for the period from the day immediately succeeding the day specified in the notice and ending with the day of completion of block assessment. Such return cannot be revised. Such return shall not be processed under section 143(1). If case of such, no notice under section 148 is required to be issued for the purpose of proceeding under this chapter. The time allowed for furnishing a return under this clause may be extended. This period specified in the notice may be extended by a further period of 30 days by AO, where the due to furnishing return of previous year immediately preceding the year of such has not expired before the initiation of such. The assessee was liable for tax audit, and such audit has not been completed on the dates of issue of such notice, and the assessee requests in writing for an extension of time. In above case, the periods to complete the block assessment shall also be increased accordingly. The AO shall pass an order of assessment determine the total undisclosed income of the block period and tax payable thereon. Tax is liable at the rate of 60%. Of course, the provision 144C DRP is not applicable, which we just discussed also. Assessment of other person. What does it mean? If in case of search or acquisition, if any asset or books of account are found, and it is found that such books of account are pertain to some other person, then assessment of such other person shall also be made as if the search has been conducted on him. Where AO is satisfied that any asset seized or acquisition belong to, or any books of account or documents seized or acquisition pertain to, or any information contained therein relates to a person other than the person herein referred to as specified person, with respect to whom such was made, or whose books of account or the document were acquisition, then such books of account and other documents shall be handed over to the AO having jurisdiction over such other person. Where there is only one specified person, block period for the other person shall be same as that of the specified person. If there are more than one specified person, then block period for other person shall be the same as that of specified person whose case the block period ends on a later date. The AO shall proceed under section 58 BC against such other person, and the provision of this chapter shall apply accordingly. It shall be deemed that such has been done on such other person. The reference of date of initiation of such or making of requisition shall be construed as a reference of date on which such books of account or other documents or asset were received by the AO having jurisdiction on such other person. The order of assessment for block period shall be passed by AO not below the rank of deputy commissioner, deputy director, assistant commissioner, additional director, assistant director, as the case may be, with the previous approval of additional commissioner, additional director, joint commissioner, joint director. What is the time limit of passing the assessment order in case of such? The order shall be passed within 12 months from the end of the quarter in which the last of the authorization for such was executed. In case of any other person, the order shall be passed in 12 months from the end of the quarter in which notice in section 58 BC in pursuance of section 58 BD was issued to such other person. However, if the case is to be referred to TPO, then the time limit shall be extended by 1 year. The period which we discussed in section 153, which is to be excluded for computer time limit, shall be excluded here as well. In case of such, the penalty is levied under section 271 AAB. In such cases, the AO or the CITA may direct that the assessee shall pay by way of penalty a sum equal to 50% of tax so levied in respect of undisclosed income determined by AO in section 58 BC. No order imposing penalty shall be made if such person has furnished a return under section 58 BC. The tax payable on the basis of such return has been paid. Evidence of tax paid is furnished along with the return, and an appeal is not filed against the assessment of that part of income which is shown in the return. Then, in respect of that income, no penalty is levied. However, no immunity is available where the undisclosed income determined by the AO is in excess of the income disclosed in the return. In such case, the penalty shall be imposed on that portion of undisclosed income determined which is in excess of the amount of income shown in the return. Before passing any order of penalty, an opportunity of being heard is given to the assessee, and the order shall be passed by the deputy or the assistant where the amount of penalty exceeds 2 lakh except with the previous approval of additional joint. In this case, since the interest is already levied at the rate of 1.5%, penalty is levied, so provision section 234 A, B, C or 270 is not applicable. Now, rectification of mistake. So an income tax authority may amend any order passed by it or any intimation issued under section 143(1) or TDS or TCS intimation to rectify any mistake apparent from record. The rectification may be made on its own motion by the authority or on the request of the assessee or on the request of the AO if the authority rectifying the mistake is above it. An income tax authority may amend any order for any matter other than the matter which has been subject matter of appeal. So, doctrine of partial merger. The assessee shall be given an opportunity of being heard before making any amendment which has the effect of increasing his liability or reducing a refund. Amendment shall be made by passing an order in writing. Further, if any sum is due to the assessee, a note of demand shall be issued to him, and in case of refund, a same shall be granted to the assessee. This is important. Time limit for rectification. No amendment shall be made after 4 years from the end of the financial year in which order sought to be amended was passed. If an application is made by the assessee for rectification, the income tax authority shall pass the order within 6 months from the end of the month in which application is received by the making the amendment or refusing to allow the claim. However, the aforesaid 6-month period shall be within the period of 4 years as discussed above. 155. 155 gives the situation where there is an automatic rectification without any application. So, what is circumstances where the rectification of order of assessment of partner in consequent disallowance of remuneration in the hands of firm? If remuneration disallowed in the hands of the firm, then corresponding remuneration shall not be taxable in the hands of partner. And in such case, there will be automatic rectification in the order of the partner. Similarly, rectification of members' assessment consequent to enhancement or reduction of income of AOP or BOI. Rectification of assessment consequent to disallowance of excess loss or depreciation allowed as a result of proceeding initiated in section 147. If under 147 any excess loss or depreciation is disallowed, then the subsequent year assessment shall be automatically rectified. Rectification associated on account of capital gain which become chargeable under section 47A. If condition of section 47 is not fulfilled, the capital gain become chargeable. In such case, the rectification is automatic. Rectification to give effect to TDS or TDS not deducted while computing tax liability. Rectification to give tax credit of tax paid outside India. Rectification consequent to revision of full value of consideration by stamp valuation authority in appeal or revision. Recomputation capital gain on account of reduction of any compensation of in a compulsory acquisition by any court. You are understanding? In all these cases, there is a need of automatic rectification. So this is a clean-cut case where there is no doubt. In such case, the law allows automatic rectification. If the stamp duty value has been increased or decreased, then the capital gain will occur, increase or decrease, and therefore there will be automatic rectification for recomputing the capital gain. Rectification consequent to revoking of patent or exclusion the name of the assessee from patent register, when deduction allowed to him shall be disallowed. Now we come to the faceless. So we discuss in income tax, most of the proceedings are faceless. So there is a faceless scheme which is for assessment, making the assessment by National Faceless Assessment Center. So there are 4 units: AU for assessment, VU for verification, technical for technical inputs, and RU for reviewing the order passed by the AU. So they have their respective functions. So all communication are made through NFSC. These units do not communicate directly with the assessees, not assessee communicate with them directly. So these are very basic and not much relevant from exam point of view. Now we'll move to our last chapter, appeal and revision. So we discussed the assessments. Now we'll discuss if the assessee is agreed by the assessment order, how can he file the appeal, where he will file the appeal, what is the procedure in the appeal. Okay. So first appeal is filed before the JCIT appeal or CIT appeal. What are the orders which can be challenged before the JCIT appeal? So any intimation issued under section 43(1) or any order of assessment can be challenged before the JCIT appeal. Any TDS or TCS intimation, any order for TDS or TCS default under section 201 or 206C, 6A, holding the assessee as assessee in default, any order imposing a penalty, order of rectification. All these order can be challenged before the JCIT appeal. Okay. However, no appeal can, however, be filed before the JCIT appeal if any of the above order is passed by or with the prior approval of income tax authority above the rank of deputy commissioner. So above the rank of deputy commissioner, there is joint commissioner only. If any of these order is passed with the approval or by the JCIT, then appeal against such order cannot lie before the JCIT appeal because both are same level officer. One same level officer cannot review the order passed by another same level officer. Appealable order in case of appeal to be filed before CIT appeal. But before this, any appeal lying before CIT appeal can be transferred to the JCIT appeal by the board or by any other authority notified by the boards. Similarly, any appeal pending before the JCIT appeal can be transferred to the CIT appeal. In such case, the proceeding before the CIT appeal shall start from the same stage where the JCIT appeal has left. However, opportunity being as given before transferring the cases. Now, appealable order before CIT appeal. An order passed by JCIT under Section 115 VP refusing to approve the option of tonnage tax. Order against the assessee where the assessee denies his liability to be assessed under this act. Intimation under 1431 or TDS or TCS intimation. An order of assessment except an order passed by the DRP or an order passed under the GAR. An order made under Section 92 CD 3. Rectification order under Section 154, 150, 145, 155. An order made under Section 163 treating the assessee as a representative agent of NR. Order made under Section 170 assessing income of business prior to the succession in the hands of successor. Order made under Section 171 relating to assessment after partition of HUF. Order made under Section 201 holding assessee to be assessing in default. Similarly, order holding under Section 206 CA holding assessee assessing default for defaulting TCS provisions. Any refund order. Order made under Section 239A with respect to refund for denying liability to deduct tax at source. Order imposing penalty. Order assessment made by AO under the such cases. Okay. So all this order can be filed appeal before CIT appeal. In both cases where appeal is filed before CIT appeal or JCIT appeal, a fee is to be paid. The fee depend upon the income assessed. Where the income assessed by AO is up to 1 lakh, the fees is rupees 250. If it is from 1 lakh to 2 lakh, the fees is 500. If it is above 2 lakh, then the fees is 1000. This is a maximum fees. In any other case, means if there is an order of Section 115 VP or penalty order or any other case, then the fees is 250 flat. With the time in filing the appeal shall file within 30 days from the date of service of notice of demand. Or if there is no service of notice of demand, that from the date of service of the order, which is to be appealed against. In case of assessment of penalty, the 30 days has to be reckoned from the date of service of notice of demand. In any other case, the 30 days has to be reckoned from the date on which intimation of order sought to be appealed against is served. However, while completing this 30 days, the period on which, starting from the date on which the application under Section 270 AA for immunity from penalty is made up to the date on which the order rejecting the application is served on the assessee shall be excluded. However, before filing the appeal, the assessee is required to pay the tax. What is the amount of tax? If he has furnished the return of income, then he must ensure that tax due on the returned income has already been paid. When no return of income has been filed, then the advance tax which was payable should be paid before filing the appeal. However, the CIT appeal or JCIT appeal may exempt the appealant from making such payment. Now, if the appeal is filed, then the JCIT appeal or CIT appeal as the case may be issue a hearing notice fixing a day and place for the hearing of the appeal. And the notice given to the assessee. Both the appealant and the AO have a right to be heard. The proceeding can be adjourned. They have a power to adjourn. They can make such inquiry they think fit or direct the AO to make such inquiry on their behalf. They may allow the appellant to go into any grounds of appeal, even if such ground of appeal is not taken in the at first instance. While disposing of the appeal, they shall dispose of the appeal by making an order in writing. Such order shall state the decision and the point for determination. So, a recommendatory timeline is given. So, it is stated that they may hear and decide the appeal within a period of 1 year from the end of the financial year in which appeal is filed before them. But this is only recommendatory, not mandatory timeline. The appeal is procedure is also faceless. Now, what type of order they can pass? So they can either confirm the assessment or the order appealed against, they can reduce, they can enhance, or they can annul the assessment. Okay. But they cannot set aside the assessment, similar to DRPL. However, in one case, they can set aside the assessment. When such appeal is against an order of assessment made under Section 144, he may set aside the assessment and refer the case back to the AO for making a fresh assessment. Only in this case, they can set aside the assessment. So this was the first appellate authority. Now, against the order passed by first appellate authority, appeal lies to the appellate tribunal, which is also called second appellate authority. Time for filing appeal before the ITAT is 2 months. It's not 60 days. It's 2 months from the end of the month in which order sought to be appealed is communicated. Okay? Remember, if an appeal is filed, then the other party may file a memorandum of cause objection within 30 days of receipt of notice. The above period can be condoned by the CIT appeal or by the ITAT. There is a fee for filing appeal before the ITAT. If the total income as computed by the AO is 1 lakh or less, then the fee is 500. If it is between 1 lakh to 2 lakh, the fee is 1500. If it is more than 2 lakh, then the fees is 1% of the assessed income. And the maximum fees is rupees 10,000. In any other case, it is 500. Where the appeal is filed by the department, no fees. In case of memorandum of cause of action, again no fees. And in case of stay application, the fees is 500. Of course, ITAT can pass such order on any appeal as it thinks fit. If there is a mistake in the order passed by ITAT, then such mistake is not rectified under Section 154, but such mistake is rectified here. And ITAT is empowered to rectify the mistake within 6 months from the end of the month in which the order is passed, with the view to rectify any mistake apparent from record, and the ITAT may pass any order amended by it. May amend any order passed by it. Similar to CIT appeal, they also recommended a timeline for ITAT. It said that ITAT may hear and decide the appeal within 4 years from the end of the financial year in which appeal is filed. ITAT can also grant a stay of the demand, but such stay can be granted only up to 180 days from the date of granting such stay, subject to the condition that the assessed deposit not less than 20% of the amount payable. Such stay cannot be extended, but it can be extended only if the assessee has already deposited not less than 20% of the amount payable, and the appellate tribunal satisfied that delay in disposing of the appeal is not attributable to the assessee. Even in case of extension, the aggregate period of the original stay and the extension can in no case exceed 365 days. An appellate tribunal has to dispose of the appeal within the period so extended or allowed. If the appeal is not disposed of, then this period of 365 days cannot be extended, even if the delay in disposing of the appeal is not attributable to the assessee. It says, the order of stay shall stand vacated after the expiry of such period, even if the delay is not in disposing of the appeal is not attributable to the assessee. There are different benches of the ITAT. One bench constitutes one judicial member and one accountant member. There is also a single member bench. When members differ, so the issue is decided on the basis of majority. If there is no majority, then the issue is referred to the president, who himself hears the issue or nominate other judge to hear the issue. In such case, the issue is decided on the basis of majority by the person who heard now, including the person who heard before. Now, after ITAT, there is an appeal to the High Court under Section 260A. However, the appeal can be filed to the High Court only if the High Court is satisfied that the case involves substantial question of law. So ITAT is held to be the final fact-finding authority because beyond ITAT, only a substantial question of law can go before the High Court. And if High Court feels there is a substantial question of law, then High Court himself formulates such question. The appeal before the High Court may be filed within 120 days from the date by which the order appealed against is received by the assessee or the principal chief commissioner. The appeal before the High Court is only heard on the question of formulated. Then appeal to Supreme Court. An appeal to Supreme Court shall lie from any judgment of the High Court only in a case where the High Court satisfied to be a fit case for appeal to the Supreme Court. Okay. Now, procedure when assessee claims identical question of law is pending before the High Court or Supreme Court. So what happens is that in one of the assessment here, if there's a question of law which is pending before a High Court and Supreme Court, in subsequent assessment here, the same question of law comes up in his case only, then he can say that I will not file an appeal if the department promises that whatever is finally decided by the High Court, Supreme Court in the earlier case is also applied in this case. Okay. Assessee shall furnish a declaration. So the AO shall furnish a report whether declaration furnished, whether the question of law is same or not, is identical or not. And the AO, the appellate authority as a case may be made by order in writing, admit the claim of the assessee if satisfied that the question of law is identical, or may reject the claim. If the claim is admitted, then AO or the appellate authority as a case may make an order disposing of the present case without waiting for the order of the High Court or Supreme Court. And the assessee would then not be entitled to raise the in relation to the relevant case such question of law in appeal before any appellate authority. In case when the final decision of the High Court or Supreme Court comes, when the final decision of the question of law is passed in the other case, the AO or the appellate authority as the case may be would apply it to the present case and amend the order passed if necessary. Why necessary? If ultimately the issue is settled in the favor of assessee, then the present case has to be amended and the issue has to be passed in the favor of assessee only, following the order of the High Court or Supreme Court. And the AO or CITAP as the case may be shall amend the order. An order admitting or rejecting the claim of the assessee as the case may be the final order, and no appeal is possible against such order. Now, here it was the assessee does not want to file the appeal because of identical question was pending before the High Court, Supreme Court. Now, if department alleges that I will not file an appeal because there is an identical question pending before the High Court or Supreme Court, and if the ITAT allows, then department does not file the appeal. Similar to what we discussed. If there's a collegium who decide that there's an identical case pending in the assessee's case himself or in any other case before the Judicial High Court or the Supreme Court, then the collegium directs the AO to make an application before the tribunal or High Court and in the prescribed form within 120 days from the date of receipt of the order of CIT appeal or ITAT as the case may be. In such application, the AO shall state that an appeal of question of law arising in the relevant case may be filed when the decision of question of law becomes final in the other case. So he will request that I will file the appeal only when the question of law has been finally settled. Application to be made only if the assessee accepts that the question of law is identical. Consequences where the order of JCIT or CIT or appellate tribunal is not in conformity with the High Court or Supreme Court decision in the other case. Meaning, in the other case, the issue is settled against the assessing. Then the AO shall file an appeal before the ITAT or High Court as the case may be, and they shall apply the issue so finally settled. So this was appeal. Now there is a revision. The revision can be in the favor of assessee or against the assessee. So under section 263, revision of order is prejudicial to the revenue. Revision is against the assessee. Here, if any order is passed which is erroneous insofar as it is prejudicial to the interest of revenue, in the opinion of Principal Chief Commissioner, Chief Commissioner, Principal Commissioner, or Commissioner, then they can pass any order enhancing or modifying the assessment or cancelling the assessment, directing a fresh assessment. Or they can pass an order modifying the order under section 92CA or order cancelling pass under section 92CA and directing for a fresh order. In these cases, it is deemed that the order so passed is erroneous. If the order is passed without making inquiry or verification which should have been made, if order is passed allowing any relief without inquiring into the claim, if order has not been made in accordance with any order or direction issued by the CBDT, the order has not been passed in accordance with decision which is prejudicial to the assessee, rendered by the Judicial High Court or the Supreme Court. While seeking whether the order is erroneous or not, the CIT or Chief CIT can examine the record. The record shall be all such records which are available on the date of such examination. Under section 263, the order can be passed only up to 2 years from the end of the financial year in which order sought to be revised was passed. 264. This is revision in favor of assessee. So again, the Chief Commissioner or Principal Chief Commissioner or Principal Commissioner, on his own motion or on receipt of application from the assessee, call for record of the assessment. Okay. If they are revising the order on their own motion, they can revise it within a period of 1 year from the date of the order sought to be revised. However, if the assessee can make an application for revision within 1 year from the date of communication of order to him. In case revision application is made by assessee, then such revision application shall be accompanied by a fee of rupees 500. Here, revision not possible if time limit of filing the appeal has not expired or order is subject matter of appeal. Therefore, under section 264, there is a concept of total merger. Even if an appeal is filed against one of the addition in the order, then such order cannot be taken to revision under section 264. It's a concept of total merger. While under section 154 or 263, it was a concept of partial merger. In case an application is made by the assessee for revision, then in such case the order has to be passed within 1 year from the end of the financial year in which such application is made by the assessee. The case, there is a option of faceless revision also. Now the CBDT has given some monetary limit. If tax effect is up to such monetary limit, then the department does not file an appeal. But if appeal is not filed because of this monetary limit, it does not become a precedent. The assessee cannot say that you have not filed the appeal in such case, then you have accepted the position, you cannot file appeal now in this year also. What are these monetary limits? For tribunal, filing appeal before tribunal, the tax effect is 60 lakhs. If tax effect is up to 60 lakhs, department cannot file an appeal. For the High Court is 2 crore and for the Supreme Court is 5 crore. Lastly, doctrine of partial or total merger. What is partial merger and total merger? Partial merger means if some of the matter are subjudiced before the appellate authority, then the other matter can be taken up. Okay. If there's a partial merger, if there's a total merger, if even a one matter is before the appellate authority, then the entire order merged with that matter, and the entire order cannot be taken up by any other authority. Okay. Section 154 provides for doctrine of partial merger shall apply where any matter has been considered and decided in any proceeding, appeal or revision relating to rectifiable order. The authority passing such order may amend the order in relation to any matter other than the matter which has been so considered and decided. The doctrine of partial merger also hold good for section 263 as we discussed. However, the concept of total merger would apply in case of section 264. The authority has no power to revise any order under section 264 if the order has been claimed in the revision is different from the relief claimed in the appeal, irrespective of the fact whether the appeal is by the cessee or by the department. So the 264 follows total merger, 154 or 263 follows partial merger. This completes our revision for today. We discussed the income tax authorities, the assessment procedure, the return of income, the assessment procedure, the DRP, the appellate procedure, the revision, rectification, and all this. Okay. In just a matter of 3 hours. And at least 4 to 5 marks of paper come from these chapters. So do revise them thoroughly. Keep revising so that it retains in your mind. Okay. And if you have any query, do let me know. So by this, we conclude our class for today. Thank you very much. Session over, sir. Thank you. Good night, sir.